Hello again. Okay, just in case I got cut off on the last video, I just want to finish the last thing I was saying. I was saying in real life, do we actually do this transaction, then this transaction, then this transaction, and use these account names? And I usually work with medium and smaller not-for-profits. And I've often the deferred going to a revenue account, not necessarily translating here and then to here. Of course, where it's really critical is year end, so you know whether you've got deferred or whether you've got a revenue. And that's about as critical as it'll get. Okay? But for our purposes here, we're going to follow the formal way of doing it. Okay, so we've got to go back because I skipped J. Late in the year, a supporter donated $50 to be held in endowment. Income earned is unrestricted. Now, remember, a few pages ago, I said endowments for deferral method are never recognized as revenue because you can never touch them. You can't use. So we will debit cash for 50. Sorry, you have to squish it in, and credit our net assets. And you know, sometimes, remember when we did share transactions in 316? Sometimes we wouldn't actually put it to common shares or preferred shares. Like if there was, we did share buybacks and we gain, we wouldn't put it right into retained earnings of some kind or contributed capital. This is the same idea. This is not revenue. So it goes right into net assets, which is like retained earnings. Okay? So be careful. Endowment's weird. We don't put it as revenue on our income statement because it is not allowed to be used. So hopefully that makes sense for the deferral method. So on page 13 again, go through and post those journal entries. Make sure you can do the statements on Exhibit 12.5, the income statement, the balance sheet. And you can read this. You do not need to know the closing entries for either type. But again, they get closed just like the restricted fund, they get closed to the net assets. Now we're going to talk about part F, which is donated capital assets, materials, and services. Okay. A not-for-profit organization is required to record the donation of capital assets at fair value. If fair value cannot be determined, nominal value will be used. So you'd use the lowest expected value. Under the deferral method, the donation will be credited to contribution capital assets, which again, when it's amortized, will recognize the revenue. Or if the asset is not depreciable, so if it's land, it goes right into net assets. So we'll never recognize revenue off that. Donated depreciable is a contribution revenue because it's got its own fund. Now, in terms of material and services, you can record it or record it. It's permitted only if fair value can be determined and if they would normally be used in the organization's operations. So, also, the fair value of services of volunteers are not recognized due to the difficulty in determining such value. Although there has been thought or disagreement about that, because you could use things like minimum wage and number of hours, that kind of thing. Because the whole purpose financial statements are doing is to help users. Now, with not-for-profits, the creditors are users and the members are users, but potential donors are users. And if you can show exactly what worth you have in volunteers, because obviously an organization that retains and uses a lot of volunteers year after year, that's a nice, stable organization. It would be nice to show that. Now, of course, you can say we had so many volunteer hours and not put it in the financial statements, but there are definitely arguments for calculating the, okay? But you guys are the next generation of accountants. Maybe you guys will develop the standard for that. Now, it says an organization would probably not record donated materials if it's an intermediate immediate distribution. So you know how some organizations collect socks and mitts and clothes for homeless people and then distribute them? They probably wouldn't record the donated material. And the example I gave also is a food bank, because generally in the past food banks did not record it. However, this has changed. And food bank, across Canada at least, record the donations by weight and assign an average value, and that'll be revenue. And then when they go out, basically cost of goods sold type account. So obviously we're not adding value or anything, and it'll come in at 10 and leave at 10. So it doesn't show any more profit. What it does show is the huge volume of food that's coming in and out. And although, like I said with volunteers, we could list that separately and say, oh, you know, we do so much food. Well, most of us don't understand tons of food. When you say it's $1 million worth of food, that gives us much more of a better picture. So, standards or things are changing. And this isn't in the standard that you can't, you have the option. So let's look at some entries for donation. And do example 3. So, equipment was donated to not-for-profit organization with a fair value of $25,000. Equipment has a 5-year life. Record the entry for the donation and 1 year's depreciation, assuming they use the deferral method. So, the donation, debit equipment, and remember, we don't have a capital account. This is the deferral method. If it was a capital account, if it was fund accounting and you had a capital fund, it'd be easy. You just credit revenue donations, but we don't here. So we've got deferred contribution, capital assets for $25,000. Now at year end, we amortize. So we debit amortization expense and credit accumulated amortization. And it's 25,000 divided by 5, which gives us 5,000. So that's great. That's easy to do. But what's the last step we need to do? We need to record revenue. So we take it out of deferred contributions, capital assets, and we're going to match the revenue to the expenses, so it's 5,000. And we're going to credit amortization of deferred contributions. And that is a revenue count. You could also call it contribution revenue, and you'll probably see many organizations doing that. Now, just so you know, if this were land, you would debit land, credit net assets. And that's it. Okay, what would the entry look like if the donation were using the restricted fund method? Well, in that case, it would all be in the capital account. Or capital, I shouldn't say account. Capital fund. So we have the donation. Debit equipment, 25,000. Credit contribution revenue, because we don't need to defer anything because it's got its own fund. And then at year end, our amortization expense and credit accumulated amortization, 5,000. Don't need to match revenues to expenses here because we already recorded the revenue because it went into its own fund. That really is, if you're dealing with a lot of capital purchases going in and out on, fund accounting is probably much easier because you don't have these extra steps in there. Okay, I'm going to end this video before I get cut off and then talk briefly about the public sector and then finish off. So the next video will be very short. I'll be happy to know.